Welcome to the world where patience pays off and the careful analysis of numbers reveals hidden treasures. Did you know that some of the most successful investors in the world, like Warren Buffett, have amassed fortunes not by chasing the latest market trends but by sticking to the age-old principles of value investing? In fact, Buffett's Berkshire Hathaway has seen an average annual growth rate of about 20% over the last 55 years, a figure that beats the S&P 500 in the long haul. But what really makes traditional value investing stand out? It's all about finding companies priced less than their true worth and holding onto them until the market recognizes their real value. This straightforward strategy might seem easy, but it requires a deep dive into financials, a keen eye for overlooked details, and above all, a lot of patience. In this video, we're going to explore 6 fascinating case studies that showcase how traditional value investing has beaten the market time and again. From the high-stakes world of Berkshire Hathaway's billion-dollar deals to the quiet success of small-cap stocks, and even finding unexpected opportunities in global markets and the tech industry, we'll show you the power and versatility of this proven investment strategy. Get ready to be amazed by stories of extraordinary gains from ordinary stocks and learn how you can apply these principles to grow your own portfolio. Let's unlock the secrets of the market together. Chapter 1. The Art of Patience, Berkshire Hathaway's billion-dollar blueprint. When you think of value investing, one name stands above the rest: Warren Buffett. The Oracle of Omaha has built Berkshire Hathaway into a powerhouse through a strategy that might seem simple on the surface but is rich in discipline. It's all about patience. Buffett famously said, "The stock market is designed to transfer money from the active to the patient." This philosophy has underpinned some of the most successful investments in history. Take the case of Berkshire's investment in Coca-Cola. Buffett began buying shares in 1988, a decision rooted not in the allure of quick gains but in the enduring value of the brand and its products. Over the decades, this investment has grown exponentially, showcasing the virtue of a long-term outlook. By the end of 2021, Berkshire Hathaway owned 400 million shares of Coca-Cola, reaping dividends that far exceed the original purchase price. Buffett's approach is deceptively simple: invest in companies you understand, that sell for less than they are fundamentally worth, and hold on to them. His strategy emphasizes going against the grain. When others are fearful, that's often the best time to buy. Be fearful when others are greedy, and greedy when others are fearful, Buffett advises. This mindset was evident when he invested in Bank of America during the financial crises. His initial $5 billion investment ballooned to over $30 billion in value, proving once again that market downturns are opportunities in disguise. Buffett's method is not about trading or capitalizing on short-term market fluctuations but rather about understanding a company's intrinsic value and the stability of its business model. This was evident in his acquisition of companies like Geico and See's Candies. These companies were not just purchases, they were investments in stable earnings and strong management teams. Chapter 2. Hidden Gems, the spectacular rise of small-cap winners. While giants like Berkshire grab headlines, the quiet success stories of small-cap stocks often go unnoticed. These companies, typically with a market cap of $300 million to $2 billion, offer unique opportunities for value investors willing to dig deeper. The secret? These companies are often overlooked by large institutional investors and aren't heavily tracked by analysts, which can lead to significant pricing inefficiencies. Consider the story of a small-cap industrial company that specialized in niche manufacturing. Ignored by bigger banks and investment firms, it was identified by a small team of value investors who recognized its potential for massive growth. They noted that the company had zero debt, a strong cash flow, and was led by a visionary CEO who was also a significant shareholder. This company, once undervalued at around $10 per share, saw its value soar to $50 per share in just 5 years. Such growth is not just luck, it's about understanding the fundamentals. It's also about patience, as these investments do not explode overnight. They grow steadily, fueled by sound management and solid business models. Investing in small-cap stocks requires a different kind of scrutiny. It's not just about the numbers, but also about understanding the market dynamics and potential for growth. One of the key strategies is to look for companies that are leaders in their niche, have a competitive edge, and exhibit financial health through strong balance sheets. Chapter 3. Contrarian Crowns, betting against the market with big rewards. Being a contrarian in the investing world doesn't just mean going against the crowd. It means sticking firmly to a strategy that can sometimes feel counterintuitive. This approach often involves buying stocks that others are selling, a move that can seem risky to the untrained eye. However, the payoff can be substantial for those who know what to look for. A classic example of this strategy in action was when investors picked up shares of airline companies during industry downturns, betting on their eventual recovery. One investor famously capitalized on the airline industry's cyclical downturn in the early 2000s. While others saw mounting losses, this investor recognized the potential for restructuring and eventual profitability. By purchasing significant stakes in these undervalued assets, the investor was poised for substantial gains when the industry rebounded. Indeed, when the market's sentiment shifted, these stocks surged, rewarding the contrarian approach with high returns. What's essential in contrarian investing is not just the courage to buy when everyone else is selling, but also the wisdom to choose companies with solid fundamentals. The mantra here is simple: look for quality companies at bargain prices. As the legendary investor Benjamin Graham stated, buy not on optimism, but on arithmetic. By focusing on companies with low debt, steady cash flows, and strong business models, contrarians can weather the storm and emerge profitable. This strategy also requires a cool head. Emotions can drive the market to extremes of overvaluation or undervaluation. It's during these periods of volatility that contrarian investors find their opportunities, applying rigorous analysis rather than being swayed by market sentiment. This was seen vividly during the tech bubble of the late 1990s, when contrarians avoided overvalued tech stocks, instead seeking out undervalued sectors unaffected by the frenzy. Chapter 4. Crisis equals opportunity: capitalizing on market downturns. Investing during a crisis might seem like the last thing to do, but for the astute value investor, it's a golden opportunity. The key lies in recognizing that crises are temporary, but the intrinsic value of strong companies endures. During the 2008 financial crisis, while many were panicking, savvy investors were buying. They were applying a fundamental principle of value investing. The market's price and a company's value are not always the same. A notable instance was when several major banks' stocks plummeted during the crisis. Value investors, equipped with research and foresight, recognized that not all of these banks were doomed to fail. By acquiring shares at rock-bottom prices, these investors positioned themselves for remarkable gains as the economy recovered and banking stocks rebounded. The strategy during such times is to maintain a list of quality stocks at reasonable prices and to have the liquidity to act when prices fall. This approach was famously used by investors who scooped up blue-chip stocks in March 2020, during the global market sell-off prompted by the COVID-19 pandemic. Many of these stocks have since recovered their value and then some, proving once again that crisis can indeed equal opportunity. Investing in a downturn requires not just financial acumen but also psychological strength. The fear of losing money is powerful, but as Warren Buffett advises, the time to be fearful is when others are greedy, and greedy when others are fearful. By staying focused on long-term value rather than short-term fluctuations, investors can capitalize on the opportunities that arise when markets falter. Chapter 5. Global Value Hunts: uncovering wealth in emerging markets. Exploring emerging markets for value investments can be like searching for hidden treasures. These markets offer growth potentials that are often unmatched in more developed economies, but they also come with a higher risk due to political and economic instability. A classic value investing strategy in these regions involves identifying companies that are fundamentally strong yet undervalued by the market. Take, for example, a consumer goods company in Southeast Asia that has been consistently delivering strong earnings but was undervalued due to regional political tensions. Value investors who conducted thorough due diligence recognized the company's robust market position and resilient business model, which were not fully appreciated by the market. By investing in such companies, investors can tap into the growth potential of emerging markets while mitigating risks through fundamental analysis. What's key in these markets is the ability to distinguish between temporary setbacks and systemic problems. This requires a deep understanding of the local economic and political landscape. As the legendary investor Peter Lynch once said, "Know what you own, and know why you own it." This mantra is especially true in emerging markets, where extra layers of complexity demand more from investors in terms of research and risk assessment. Another effective strategy is to focus on sectors that benefit from domestic growth trends, such as infrastructure, telecommunications, and consumer staples. These sectors often contain companies that are not only market leaders but also have government backing or favorable regulatory environments. By investing in these sectors, value investors can leverage local growth dynamics while adhering to their principles of value investing. Chapter 6. Tech under the radar: finding value in Silicon Valley. It's a common misconception that value investing and technology stocks don't mix. However, savvy investors know that opportunities for value investing exist even in high-growth industries like technology. The key is to look beyond the hype and focus on companies with solid fundamentals that are trading below their intrinsic value. One approach is to look for technology companies that are leaders in niche markets but have been overlooked due to the dominance of bigger tech giants. For instance, a company specializing in cybersecurity solutions for small businesses, a market less penetrated by the major players, may offer substantial value. These companies often have strong growth prospects but are priced reasonably due to being overshadowed in the broader tech landscape. Investing in such companies requires a careful analysis of their financial health, market position, and growth potential. It's not just about picking any tech stock, it's about finding those that offer sustainable competitive advantages and robust earnings growth. This strategy was effectively employed by investors who identified potential in cloud computing firms before the sector became a mainstream investment destination. Additionally, value can be found in mature tech companies that have gone through their explosive growth phase but continue to offer stable returns and strong cash flows. These companies may not grab headlines like their faster-growing counterparts, but they provide the kind of steady and reliable performance that value investors cherish. By applying traditional value investing principles to the dynamic tech sector, investors can uncover significant opportunities that others might miss. This blend of old-school discipline with new-age sectors demonstrates the versatility and enduring relevance of value investing strategies.